Well, we have kicked off 2024, the first trading day of the year, and as investors are gearing up to strategize how they should plan their money and their investments going forward, we have some help coming in from Motilal Oswal Private Wealth. We have Ashish Shanker joining in to give us a sense of how they're looking at 2024 and whether it's mutual funds or, equity or debt or gold, really how we should be managing our money this year. Ashish, thank you for joining in. Season's greetings to you. Wish you a very, very happy 2024. Hopefully it'll be a very positive year, personally and professionally for you. So greetings of the season. Tell us, 23 was very charitable for most investors. Do you expect 24 to continue that good touch?
Thanks, Surabhi. Wish you and Reema a very, very happy 2024. Wish all your viewers a very happy 2024 as well.
Thank you.
Surabhi, I think we publish this research report called the Alpha Strategist every month. And generally, the January report is our forecast for the calendar year. Okay. And if you look at the last 3-4 years, I think we've got it reasonably accurately correct. This year, if you ask me, is the most difficult to call. And I'll tell you why. See, we've had a superb run for Indian equities. Last 8 years, we've seen positive returns. Now, this has been backed up by fundamentals. Last 5 years, earnings has grown by 15%. Debt is also looking very good because you're looking at lower rates in the coming 2-3 years. And even US Fed has paused. So if you ask me, Surabhi, I think this is the year where people should just stick to their core asset allocation and keep it very, very simple. Because we are not worried. There are pockets of excess valuations. There are pockets of exuberance. But I have never seen such a perfect setup, ever. Even in the bull run of 2003 to 7 or 2 to 7, we had 6 years of positive returns. This is the 8th consecutive year of positive returns. So it's a tough one. But I would say this is a year to stick to basics.
Ashish, I take your point because in the morning when we come in, we all look at the queues. And this morning when I was rounding up everything, the only worry is that it seems too perfect, right? Like you said that earnings have been good. Everybody's calling for very decent GDP growth here in India. Then there's talk of rate cuts. It's almost too good to be true, all of it coming together. But having said that, help us out here. Let's start with equities. Now, how should investors go about deploying further money? Because the problem is if you get a 1,000-point dip on the Nifty, everyone knows what to do. It makes the job easier, but we're not getting that dip. So how should investors look at their equity allocation this year?
Right. So let me go more granular now. So if you look at equities, right, we've had a fantastic run for the mid and small cap indices over the last 3 years. There are pockets of excess valuations. I wouldn't say that this is time to take money off the table from mid and small caps. But incrementally, what we are recommending is to maybe deploy in flexi caps. And the reason for that is if you look at the Nifty and the large cap space, whilst the markets have run up, but valuations have not. Reason being that earnings have kept pace with the growth in the Nifty. So if you look at valuations for the Nifty, we are closer to 19 times 1 year forward, which is marginally lower than longer term averages. So there is no worry, cause for concern on the Nifty. Similarly, if I look at the mid and small cap indices, there are pockets of value available. So we believe that given that there is reasonable certainty in terms of the election outcome, it is never certain, but given the trend in the state elections, it looks like, we may have the same government formation back in May. And so if that uncertainty is behind us, then we are also looking at lower rates sometime later this year. US Fed has paused. Indian, RBI has also indicated that they may look to lower rates later this year. So from an equity point of view, it's looking good. But the only thing I will tell investors is that please moderate your expectations, right? If you had very high double-digit returns in the last 2 to 3 years, maybe you should be expecting lower double-digit return from here on. But equity still looks like probably one of the best places to be. In terms of sectors and in terms of, if you look at which parts of the market has done well, last 2 to 3 years, and this is what we were calling for, the sectors which are value sectors have done extremely well. Now, the other way to look at it is that these are sectors which have been neglected for the last decade. Industrials, capital goods, real estate, autos, I do believe that this trend will continue, because generally when there is a trend change, right, which is what happened according to us in 2019, 20, 21, the trends continue for long, because there has been severe underinvestment in these sectors over the last decade. And we are continuing to see positive news, continuing to see a lot of investment from the government and private companies in some of these sectors, whether it's electrification, whether it is railways, whether it is building out the infra for the country. So we continue to be positive on these sectors going forward as well.
Ashish, morning. Reema here. If someone has lump sum money to deploy, a one-time discretionary spend, it's easy to continue your SIPs. But what if there is this big one-time bonus that some employee has got, or you've just got cash to deploy a big amount? What would you recommend then?
So again, going back to my earlier answer, first is you need to figure out your asset allocation. So let's say if you're a 50 equity, 50 debt investor, or let's say 50 equity, 40 debt, and 10 in gold, the incremental money also should be deployed in the same fashion. Okay. Now the equity money, like I mentioned, I recommend flexi cap funds. Let the fund manager decide whether he or she wants to buy large caps, mid caps, small caps, because they are making that decision on a daily basis on valuations and which companies, which sectors look good. But once you made that decision, you should deploy lump sum, because the setup is looking extremely good. I mean, if you stagger, my worry is that you may end up getting a much higher average, and then on a monthly basis you're worrying whether the market's overvalued, undervalued, whether you get a correction. Once you made that asset allocation decision, I do believe that you should go in there and deploy that money upfront.
The equity outlook is attractive enough for people to invest a big one-time lump sum amount even at these levels.
Absolutely,
right?
Because see, valuations, like I said, on aggregate are at averages. There are pockets of excessive valuation, but let the fund manager decide that. And the setup is looking pretty good. The other thing which I didn't mention is this is the fourth consecutive year of double-digit earnings growth for the country. I mean, it has never happened in the past. In fact, 3 years in a row has never happened. This is the fourth year of double-digit earnings growth. So all this positive sentiment, momentum, liquidity is getting backed up by fundamentals as well. That's the good part.
Ashish, I guess it's also that year where we're a little spoiled for choice, right? Because look at what's happening in the US. Bonds have started now rallying. Equities anyway rallying. Now bonds are rallying. Gold has had a very good run as well. So again, coming back to the Indian context here, what would you recommend on fixed income funds, and also a word on gold?
Yeah, so fixed income, we had a major change of view in September, October. In the previous 3-4 years, if you've read any of our publications, we were messaging to our investors to invest in 3 to 5 year kind of maturity, and basically these are accrual kind of products where you, let's say, if you invest at 8% yield, you end up getting that 7 or 8% yield. In September, October, we put out a view that we are now very comfortable with duration. The reason being that we are expecting inflation to moderate, and this is a global phenomena, so that will translate into India as well. And we do believe that yields will head lower in the coming couple of years. It is not going to happen in a hurry, though. We had also mentioned that we believe inflation and higher rates will be a bit sticky. But if you take a 3 to 4 year view, it's a good time to accumulate funds which have 8 to 10 years maturity or duration of between 6 to 8 years. So essentially the long dated gilt funds. And today for a HNI, there is no difference between, let's say, a mutual fund and buying a bond directly, although mutual fund gives the benefits of diversification, etc., and compounding. But you could buy long dated papers directly in your portfolio as well, depending on what is your taxation. So that's a major change in view. We are telling investors to buy long maturity fixed income products right now. Coming to gold, Surabhi, our view is positive on gold. And there are multiple reasons. I mean, if you look at the world, the geopolitical tensions have only increased over the last couple of years. So there are a lot of unknowns out there. Secondly, as interest rates go down, we do believe that gold continuously becomes an attractive asset class, and there are shifts in currencies as well. So it is a very good idea at this point in time to hold reasonable amount of gold. Now, depending on how you're allocated, we do believe 5 to 15% is a decent enough allocation for somebody to have in gold-related products.
Thank you very much, Ashish, for that informative chat with us. We will slip into a very short break on that note. We'll come back with more on the market. Stay tuned.